Hello, everyone. Welcome to the very first episode of The Art of Alpha. It's going to be a podcast where we discuss trading, finance, taking risk, and most importantly, community. I know as a trader, as a sole trader, it can be a very lonely game. A lot of us are introverts, and also the fact that we can't really share our alpha. It's hard to be out there,
be seen without giving away the secret sauce. So what we are trying to do on The Art of Alpha is unmask these people behind the scenes and just get to know them a little bit and try to build a sense of community around the actual trading community that we have out there. There's not many of us, but I'm lucky enough to have known this man sitting across the table from me, Mr. Steve, coming all the way from Chicago. What a legend this guy is. He has been trading.
Only in Jordan's mind, really.
Well, that's the thing. I'm one of the very few, people who know what you're all about, Steve. And coming all the way from Chicago, one of the best traders. You had an insane year this year, and I hope we can get into the numbers on this podcast. But I guess a little bit about you, Steve, from my perspective, from knowing you. You are a risk taker, someone who can really put their foot on the gas when needed, and when you see edge, you smash it. And
get a risk aggression, we call it sometimes.
You've been a friend, a mentor, and an amazing business partner. So thank you so much for coming on the podcast today.
Yeah, glad to be here. It's my pleasure, really.
All right, Steve. So I guess we're going to kick this off right away. This podcast is going to be a little more technical. The people that I think we want to reach out to are traders like us. And to reach out to them, I think we need to be more technical. And so that's why I think we're just going to jump right into it. Steve, be yourself, and let's roll.
Okay, sounds good.
All right, Steve. So you didn't have any formal trading experience. You never worked in a big hedge fund?
Not in an official capacity. Yeah, my family owns a road striping business, and I worked there since I was 13. So small business is risky. So I got risk experience, but yeah, no formal finance, no industry, nothing trading related to any of my employments.
So I want to ask you then, how did you get into trading?
Really, I think it just came about when I dropped out of college halfway through my second year, got married, and then started thinking, okay, so what's next? How do you support a family? Right now, I've got pretty much nothing. I used most of my money that I saved growing up in my teenage years working to pay off my wife's student loans. So it's pretty much a start from scratch. Some residual debt, quickly got that down to zero. And I'm not a big spender, so I was like, okay, what's next? What do you do with the money you're starting to save? How do I grow it? And one of the most common answers is, well, invest it. And I was like, okay, people say that, but what does investing mean? How can I optimize this? And so at the very beginning, I was just thinking, how do I grow this capital I've saved from working? Because I never liked the feeling of living paycheck to paycheck. I always wanted a buffer. And so naturally, I would save money. I would not want to spend as much as I was making. I want to spend less than I'm making. And so you accumulate surplus. And I was just thinking, what do I do with the surplus? Started studying investing. And that's like the very beginning, I'd say, of starting to expose yourself to variance, starting to expose your capital to variance, trying to grow it, et cetera. That's the very beginning.
Okay. And there's a big difference between, starting out as in the trading field and then actually starting to generate P&L. And without a background, how did you learn this stuff?
Yeah, it took a long time, a better part of a decade probably. The knowledge is kind of, again, even the knowledge on how to save, make basic budgets, invest your money isn't taught in school. So, but the information is public if you want to read finance books and read online forums. It's kind of, crafting a beta portfolio is not secret. So you can find that knowledge, but how I stumbled upon trading knowledge was just a bunch of trial and error. You know, I was thinking this is the conventional wisdom for growing money with beta. How do I do one iteration better and one iteration better? And not having any experience, you end up going down a lot of wrong paths, you know, especially without a mentor. It took me a long time to understand, you know, what even delivers excess returns over your normal bond premium or macro equity premium. That took me a while to even start understanding, like, you know, what is the market paying for? You know, what is risk premium? Why does it exist? Where does it exist? And like, even to start thinking about it in those terms took me years of trial and error.
And once you started learning about risk premium, is that where you initially started your trading? Because I remember you talked about you were trading commodities at the time.
Yeah. I mean, again, it's really there's no key moment, key epiphany, but it was really just multiple iterations again and again and again. So I had equity bond. You know, I was asking myself questions early on, like, what's the appropriate amount of leverage? People told me don't use leverage, it's dangerous. But I actually looked at the data and I was like, well, you know, too much leverage is dangerous, but some leverage can enhance returns. You look at diversification, how that can, it doesn't diminish your arithmetic mean return, but it does diminish your variance. So you actually add Sharpe ratio by diversifying, which you can make a more efficient portfolio and then lever it up to get a higher return. So we're really looking for efficiency here. How many units of return versus units of risk? And then, you know, to seek more diversification, I started looking into other betas, alternative betas. So, for example, rental real estate. That's one of the things I started looking at. And commodities, too. I was like, you know, are there predictable signals that have persisted for multiple decades that show some positive expected value if you trade them? So, I mean, very early on, I was like, if commodities are in steep backwardation, you know, I want to be short in the back and let it roll down, because if you study the data, you'll see spot price backwardation isn't always 100% predictive of future spot. It's sometimes just a measure of supply and demand. So, you know, I'll short, I think I might have got that wrong. Short contango, go long backwardation, because you want the futures further in the term structure to roll up or down to spot. And that has persistent edge. So, I mean, I'm like, now if I can find persistent edge there and capture it, I could add that to my portfolio with stocks and bonds. I could increase the Sharpe ratio. I could increase the leverage. Again, it's just really, I'll trade anything that I think has edge. You know, one time Jordan was asking me, he's like, hey, how's it going? I'm like, yeah, pretty good. I've got like $1,500 in the Raptors tonight. And he's like, you're a sports bettor? Like, why are you betting on sports? And I'm like, hey, I'll take edge anywhere I find it. There was a promotion where this one sports book was going to give you a voucher for up to $1,500 if you made a first-time deposit bet and then lost the bet. They'll give you this voucher back. So I'm like, that's edge. I've deposited $1,500, bet the thing, knowing if I lost, I'd get the voucher to make another bet. So I mean, we're looking at expected value of like near $1,500. I won my first bet, so I didn't have to like fiddle with their dumb vouchers and stuff. But again, I only made that one bet. I withdrew. My account's closed now. I just went there to get the edge. You know, I'll trade anything that has edge.
But you know what I found funny about that scenario, Steve, was $1,500 to you now is, you know, it's $1. It's a penny.
I wouldn't go that far, but I get what you're saying. Yeah.
Especially after the crazy run that you've been on this past year. It was some of the best trading I've ever seen. And also that you mentioned how you'll trade anything, not just options. I would say would you say most of your P&L has come from option trading?
Yeah. I mean, really, I probably, again, I'm not, one of the things I'm bad at is like actually aggregating my P&L. I'll do it for tax time. I'll do it if I have a question I'm asking myself, like, you know, what trades make me the most money? What's the variance? I'll go back and I'll check my data, but I really don't carry around my historical performance in my head. I would say a large part of my P&L is through options, but that's just kind of, I'm familiar with them, so I'll express even delta views through options in part just because of familiarity. But again, a huge part of my net worth, I guess you'd say, came from the fact that, I mean, when interest rates were low, when debt was 3% in 2018, I was borrowing as much money as I could from everybody I could. Every bank, I'd try to push these deals through. They'd be like, "Oh, your balance sheet, we're not sure if we want to lend you this." And I'd be like, "Please, there's got to be a way." Like, what if I did this? What if I did that? What if I deposited lease reserves so you don't have to worry about a default the next 6 months? Or, I try to help them solve the problems that were preventing them from giving me more money. And so I had massive amounts of debt at low interest rates. And then these past few years, when inflation really woke up, my liabilities are getting eaten away at it in real terms of real buying power. And the assets that I bought, namely mostly real estate, but again, some investments and trading strategies and equities and stuff, inflation hits those for nominal gains. So, I mean, that spread just like blowing up made me a ton of money. So the options even, I traded a lot of option strategies with borrowed money. So really the spread between like the debt and the P&L that I've been able to generate and the appreciation on the hard assets that I bought, if I could isolate like one main driver of my P&L, it was that. And again, it's partially luck really, because I thought to myself, I was pretty confident getting money for like 2 or 3%. This has got to be a good trade, because what's the worst that happens? Inflation flatlines at 0 and you're paying like 2 or 3% real cost for your money. It stays the same at 2% and you're pretty much getting money for free, or inflation happens and then you're making real gains on that spread. And I got lucky that inflation really woke up. I wouldn't have even told you we'd see like 8% prints on CPI. I didn't even think it would go that high. So that all this was just like an extra tailwind on this kind of macro kind of risk idea I've been working on for the past 5 years.
And last night you actually said you started to unwind some of your real estate. So Steve,
yeah.
Can we actually talk a little bit before we get into the option trading? I know real estate's a big part of your life.
Mm-hmm.
Can we talk a little bit about your portfolio in real estate and what you've been doing to unwind recently?
Sure. So you're just interested in what I've been selling or why I've been selling it or what?
Yeah. So basically your portfolio, I know you have a massive portfolio, and then just how you're unwinding some of the positions like you mentioned to me last night.
Yeah, so two kind of catalysts, I guess, to the decision to start unwinding some of my real estate. One, I've started buying in bigger size pretty much for the last 5 years. My first purchases were in 2017, a lot more in 2018. Started buying all the way up till January 2021 was, I think, the last time I bought a non-residential building. So the one thing that made me start to unload, primarily the immediate catalyst, was that a lot of my loans are on 5-year balloons. So I got the loan 5 years ago. Now it's time to, essentially the whole loan is due, and you can either pay it off, but more commonly you just refinance and get new loan terms from the bank. You're marked to new terms, new collateralization levels, et cetera, everything. So instead of going through this refinance process, I was actually rejected on one of my buildings for another 5-year renewal, and this was, I think, early 2023. The renewal was in May 2023, so it actually kind of was pretty jarring. So they're like, pay off this loan for I think the loan balance was like $405K, and they're like, no, we're not going to let you refinance this because we don't stress your global portfolio. Our investors want good performance on the exact building that this lien goes against, and this building's income is less than our current underwriting threshold. And so, and again, like I did what I always do, I try to work with them. I was like, can I post more collateral? Can you hold lease reserves? Is there any way I can augment the income to this? Sometimes you'll accept plans for forward revenue increases and stuff. So I'm like, can I give you a study with my property manager? Show you what rent increases we've got in the next year and what you can expect next year, anything to get over the bar. And so this negotiation went on for a while, and I ended up getting, I think, a 7-month extension on my credit, and they were going to reassess the income at the end of the year and see if my projections actually panned out to, what they were looking for. But all throughout this time, I had it listed for sale. I wasn't looking to quick get out of it because I could rearrange other things or borrow more money from a different place or sell some of my assets to pay down the loan in worst case. But, or in best case, the building would start performing and they'd give me another 5-year renewal. But I ended up getting a pretty competitive offer when I had it listed while I was doing these things. And so I ended up selling it instead of renewing the for the next 5 years. And interest rates are higher now too. So I mean, I thought lending money at like 3% was a screaming deal, but now the market's already priced in the possibility. I think they've gotten closer to fair pricing for interest rates now because we've had inflation. We've got to see it with our own eyes, and it's not just like some future possibility. So now interest rates are factoring in the possibility of high inflation, and that's partially why they cost like 6-7% now to get a loan. So, I mean, I think 6-7%, I'm still happy to lend money or borrow money at that interest rate, but it's no longer screaming like this is a great deal, like get as much as you can to me. So some of my loans, the easier ones, I'm renewing. Some of them, if the buildings are underperforming a little bit or whatever, I'm unloading those. And then again, so that was like the immediate catalyst. The refinancing at higher interest rates kind of makes me want to sell some of them. And like I already kind of talked about, now that I have 5 or 6 years of historical performance, I just kind of found the way I run my real estate, the worst performing type of real estate I have is these larger apartment buildings, like the 6 units up and on up. Single families and commercial buildings are kind of nice because you have tenants that stay for longer periods of time. Sometimes that means they're also vacant for longer before you can find another long-term tenant. But I found because I don't run a property management business myself and do all management in-house, that these apartment buildings, although they have higher gross rents, they also have more inefficiencies where it's like I don't have my own labor crew that I am paying like 25 or 30 an hour to go paint rooms and stuff. What we're doing is we're calling up contractors when we need to turn over a unit and saying like, hey, can you paint this, repair this flooring? And they're like, if they're busy, they're like, sure, I'll do it for $4K or whatever. And then you're kind of like in a lurch, you know, you have to pay their margin on their business, their overhead. And so I think just hiring out third-party management is just not a good fit. You know, I like to do things data-driven, but theoretically I'd like to understand like why I'm making a certain decision. And I think, you know, one of the conclusions I came to in real estate was that I'm just not an efficient end user of these apartment buildings because I don't run my own property management infrastructure. Like it was actually a win-win when I sold this one building that got us into this conversation, because I sold it to a property management company that reinvests the management fees they earn into their own real estate, and then they use their management infrastructure to manage their own properties. So I mean, this building makes like over $120K a year in gross rents, and they're going to be able to capture way more of that than I am just hiring out. You know, I have a good property manager, but you know, I'm just not optimized. The vertical integration isn't there. So I'm kind of unloading all the bigger apartment buildings for now, and that'll let me partially de-risk, you know, not carry as much debt as higher interest rates. And hopefully, you know, if this is not just a sample size thing, it give me some theoretical future better performance because I'm unloading the worst performing buildings. So that's kind of a few of the things that went into that decision-making process.
You know what? And also, I'm sure you're spending too much time trading options as well.
Yeah, that does take some of my brain space, yeah.
Steve, so actually on that note, I want to get into the year you've had. It's like an incredible year.
So far.
Yeah, you got a big trade on, which we will get.
Yeah, I mean, I got a trade on right now that could wipe out most of the year's P&L. So, I mean, really, you take snapshots. I've had good runs before.
Yes.
And that's one of the things that's always been hard to communicate properly to people who don't, like, live out in their day-to-day life extreme variance swings, because there's an idea that, like, you know, once you've earned P&L, it's kind of yours. Well, it's only yours if you de-risk and if you take it off the table, because my grandfather actually was one of the people that invested in my business earlier on. And I've had a run like this before. And he was like, this is amazing. We're making tons of money. And I could never fully explain to him, well, risk cuts both ways. If you run high variance, you can get higher outcomes to the upside, but your losses are also much more extreme. So I was like, you know, it's way different than if I had a W-2 earning like $500K a year. If you're doing risk-taking activities, making $500,000 a year, unless you're lucky forever, eventually you're going to have outsized losses. And that did occur to me. So this is the second time around the bend, a huge run. That's not the first time I've had a big run. I know how they end, usually in big drawdown. I'm trying to do a little bit better job this time of de-risking, but it's glamorous when it's happening. I mean, it is exciting. That's normal. You know, it's cool to tell people about, but it's harder for me to get excited about this time around because I know it's just, you know, just one snapshot in time. We could have been talking 3 years ago before, I think, really the first quarter of 2022 is when several years of my work came crumbling down, and things would have looked the same to you then. You would have been excited, thought I had a big run. You looked at me like 6 months later, and I'm like flat for 2 years. I wiped out years of P&L. So,
And I actually never understood why you de-risked until I ran into my recent debacle. So it makes a lot of sense now after having gone through that, that it makes sense to, once you hit a big swing, you need to take some chips off the table.
Yeah, and it's not easy to do because you might be leaving early. It's really hard to optimize how much risk should I take. I mean, that's not an answer you could just plug into a formula and get an answer. Personal utility plays into it. What's going on. There's so many things factor into that decision. There's no clear right answer. I can calculate what do I think the fair value of this is. I'll give you exact price. I'll give you a bid ask on this asset. You describe me a theoretical asset. I'll quote you wide if I'm uncertain, but I can give you a bid ask. Like I can get it down to nuts and bolts, solid number. With math, with whatever, like if I have uncertainty, I'll widen my spread. But you ask me like, how much risk should I be taking? What percent volatility should I be targeting for my annual net worth? I mean, I don't know how to answer that. It depends. There's a wide range of answers that are acceptable. If you're feeling risk averse, don't risk that much. If you're young and you can, make back your risk capital in a few years, maybe the answer is a lot. If you're just about to have your first kid, maybe not. There's non-mathematical factors that just really dominate some of these questions that make them hard to solve. Yeah.
Okay, Steve. And before we get into that discussion, because I do want to ask you about your thoughts on risk, let's talk some numbers here. So this year's P&L, I know I've seen you the last quarter, I think, just make $1 million.
Yeah, probably. I mean, there's losses in between those, but they're not huge ones. So it's like, again, I'm not good at keeping the numbers in the back of my mind, but yeah, we've got, 3 major trades since my daughter was born in July. I've been working nonstop, probably taking a bit too much risk, and I ought to stop before it starts taking too much of a toll on me. But yeah, since then, 3 major trades that have printed like 270, almost 500, and then again 220. So that was the 3 big winners I've had since July.
You also had Amazon too, and that was $500K. I remember that.
Yeah, you're right. Okay, so even before, a little bit earlier in the year, we had another 500 in front of that. And again, these are interspersed with losses too. Like I've lost 200K on ARM.
On ARM, yeah.
I lost. Man, once I'm done with the trades, they leave my mind. But that's not that's not the only 6-figure loss I've had. So definitely, it's been a good run. But really, my tax time is the only time I really get it straight for the year. And after that, it's just kind of things are in flux. So
okay, so let's talk about one of your big trades this year. Let's talk about which one. What's a story you have, Steve, that you'd like to share? One of the trades that really stood out to you this year. Actually, you know what? I want.
Yeah, you tell me.
I want to say, okay. VFS. That was probably the best trading I've ever seen. And you netted what? Just over $500K USD.
Yeah, I
on
think
that?
so. Yeah.
So, just to give the backstory, I messaged Steve saying that there was a bunch of retail interest on VFS. The stock had rallied like 300%, 400%.
Yeah, it went from like $20 to 90 or something like that.
Yeah, it was short squeezed, and implied vol shot up to, what was it, 300?
It's so hard to get an accurate figure because there's so much borrow embedded into the chain. It's really hard to know. We just have the option price. And the broker will quote you the vol figure, but it's really hard to know what's coming from borrow, what's coming from vol.
Okay, so it was I think it was $200 billion market cap. It was like bigger than Goldman at the time.
Yeah, almost like the bigger than everything beside Tesla. I think they like eclipsed Ford and stuff. It is crazy.
And if you just looked like 3 months into the future, 6 months into the future, there would be no way this company would be trading.
But that was reflected in the
value.
forwards. I mean, even when it was at 90, the forward was at like $25.
I think that was still like $100 billion market cap, though.
Yeah, the forward was still too high, but I'm just saying the market knew it was coming down.
Right.
That's why it wasn't a no-brainer to trade. I mean, already the forwards were really low, so it was, not the easiest question to answer. How do I turn this into P&L?
So can you maybe talk us through seeing the edge, why you thought there was edge, and what you did about it.
Yeah, well, it's actually, it was, again, so much comes down to luck, good timing. You can't reproduce a lot of this stuff. It just, there's a sense of if you're watching and you're ready, you might be in the right place at the right time sometimes. So one of the biggest advantages I had was I just traded equity units against stock ARB like a few weeks beforehand, and that was AMC. AMC had APE, AMC preferred equity units. They were trading under the AMC shares. AMC shares had huge borrow because people were like trading that spread, short AMC shares, long the units, which were going to settle into actual AMC trades shares. So the trade settles itself. So I traded that in a riskless manner. I was short close to 1-to-1 AMC shares versus AMC equity units, and the trade settled, and I netted out a decent bit. But that was fresh in my mind, and this time for VinFast, I was like, the one thing I would have done different on AMC in hindsight, I was like, why didn't in any spread, you can be really confident that the spread has edge. If let's say, you're buying gold for $10 and I'm selling it for 2,000, we know that you buy from Jordan, or you short my gold and then, sell it to this guy for $10 and you're going to earn. So the spread we know has money, but which leg is the mispriced leg? Is it me selling gold for 1,000 or is it you buying for $10?
Right. And that is what we had an issue discussing, right? Which was, what was the alpha leg?
Yeah. Which leg? And now they could both be mispriced to a degree. And if they're both mispriced, 1-to-1 trading makes sense. But in AMC, even at the time the trade was going on, even though I traded it in a riskless ARB manner, I was really convinced. I was like, no, short AMC shares, because of the limited availability of them and the, maybe lack of capital being able to trade options, maybe the short synthetics can't be traded in big enough size to push that price down to where it should be. I was like, I think AMC short shares is the leg with more edge. So what that means is I think the AMC shares are going to come down to meet APE. I don't think APE is just going to go up to meet AMC. And so in VinFast, though, I took that knowledge and I was like, the VinFast shares have to be the mispriced leg, not the forward/warrants that were available for trading. So I really packed risk on to what I felt was the alpha leg. So I still had a spread on, but I didn't do a perfect ARB. And a perfect ARB makes you money no matter what the outcome is, as long as you don't get liquidated.
What was the spread, Steve? What was the spread you put on?
It was complicated, but in the once you aggregated my position, it was a higher concentration of risk on the short VinFast deltas than it was on long the warrants and the hedge and everything. So I overweighted what I thought was the alpha leg, and it turned out that I was right. The shares did come down, and more so than the forwards and the warrants went up. And so I made more because I took a step away from using arbitrage, and I packed risk onto the short leg.
What was really amazing about that trade, though, was how you pushed the pedal down.
I kept going even when it was halfway mispriced or whatever. You made
Yes.
like what, $200K, and you're like, all right, I'm good or whatever. But I was
Yes.
like, no, it's still going down more.
Exactly. And you kept
conviction
pushing
is
it.
how you earn a lot of money. After seeing it happen with AMC, and I might not have even been right. Again, it's so hard to separate skill from luck. I could have just been like applying what happened in AMC. That doesn't happen every single time. But, I could have even had a false confidence watching it happen with AMC and then thinking it's going to happen again. And luckily it did. But, I took serious risk. It could easily go the other way on me. I kept shorting it all the way down. I didn't stop until I felt like it was fair.
That's probably the biggest takeaway that I've gotten from you trading with you over for the past 3 or 4 years is price fair value, and don't stop buying until it hits that price.
There's like a sense of annoyance too. I'll tell Jordan or whatever, like, let's say we think something's worth $15 and it's trading for like 12 or whatever, and we'll buy it. It'll tick up to 13, and he's like, "Oh, good, we got a big position on. I hope it goes the rest of the way." I'm like, "It's still under 15. I'm still buying. Like, I'll buy it at 14. I'll buy it to 14.50." You do want to still control your risk. You can't just be like a total gunslinger. There is a truth there that's good not to forget. You're adding a trade with less implied edge the further you go. So we bought the first shares at 12 when we think 15 is fair value. Every unit of risk, we're capturing $3 of expected value. But when it ticks up to 13, now you're only capturing $2. Now you're only capturing $1.
Yes.
So it's like there should, again, it's a balance. You shouldn't just fill one block and then be done and hope for the best if it's still dislocated in price. But you shouldn't be adding massive risk just for like the last 10 cents of edge. So again, it's a balance. Yeah.
And it's definitely a mental struggle too. Like you were just buying it for $10, now it's $12, and you need to keep buying. Right? That's the right play.
Yeah.
And getting over that mental barrier that
Yeah.
you had just bought it for.
And
10.
it's tough because one, there's less edge. But let's say our loss case was like, this company we're betting, or we think that they're going up to 15, but the one thing is they've got a drug patent pending, and if the government rejects this, they're going to $5. Like that's our loss case. No matter what the price of the stock is now, we think it's worth 15, but if this tail risk occurs, it's going to be worth 5. So in the same sense that you're getting diminishing edge when you keep buying, you're also adding more and more risk. So you buy a share for 10, your loss scenario is only going down to 5, you lose $5 per share. Now you're at 11, you're capturing less edge, and now your loss case is $6. You go up again, your loss case is $7. So the edge is going down and the risk is going up. It is hard. Again, it's a balance. And a lot, like we talked about earlier in the podcast, a lot of these questions are not easy to answer. There's no exact formula you should use on how much risk should I take. You're constantly, it's one of the challenges of the business. Yeah.
Yeah, actually, you always tell me, as a trader, we get paid to be psychologically tortured.
Yeah. You really latched onto that.
Yeah.
I said that one time. Yeah.
Okay, Steve. So, knowing you, regular guy, if on the outside, if people don't know you, they don't know the risk you take, swinging millions of dollars around, taking care of a family, taking care of the people you love.
Mm-hmm.
They just see you on the surface, regular guy.
Yeah.
And I've noticed that a lot of traders, a lot of risk takers, the ones that I've seen generate a lot of alpha, are actually very humble people. They don't flash their money.
Mm-hmm.
They keep their capital to be able to leverage that, right? That's your gunpowder.
Mm-hmm. Yeah.
And I want to get your thoughts on how you live your life, given that you are a risk taker, right?
Mm-hmm.
It's a very different life, being a risk taker and earning your money through a lot of variance. So I'm curious to know how you keep your overhead, why you keep your overhead low, and why you think that a lot of real risk takers are very humble people and not so flashy.
Okay, yeah, two-part question. The easier one to tackle. How do I keep my overhead low and why? I mean, again, I always kind of, even back to the beginning of our podcast, I always just felt more comfortable with a buffer. I never wanted to be having future expenses and uncertainty whether I would be able to pay them. That annoyance of kind of having uncertainty about, am I running too close to cash neutral? Like, I could barely afford my house, whatever. That annoyance and feeling that I was being a bit, if I did that, I would feel like it was actually in part a moral failing. You're not being prudent. You're not being responsible with your money if you don't have any savings, if like an unexpected event could cause your family a lot of disruption. And so from a moral standpoint, I always felt, we ought to be disciplined with our use of money. We should keep savings, make a stable environment for our own lives, for our family. So the feeling of annoyance of the uncertainty, the feeling of moral obligation to be prudent with money outweighs any passing. I've never been materialistic to begin with, but that outweighs any passing pleasure of, I'd rather drive like a normal car than have people think that I'm, cool for having the latest sports car. I just never been very materialistic. Any passing pleasures are nowhere near the enough to outweigh and get me to act in an undisciplined manner than those previous motivators to save and be fiscally responsible that I mentioned. And I think it's easier too because again, I'm married to a wife that's kind of the same way. We're both a little bit countercultural. We've never really felt like we fit in or kind of feel pressure to conform to societal norms. So it's like we don't have a TV at our house. We don't have internet. For a long time, we had one car. Yeah, I like real estate, and there's a particular loan that if you're owner occupied, you can use it for a building that has up to 4 units. So at the time, we had 5 kids, and we moved into a 2-bedroom little apartment thing because I wanted to use this loan, which the stipulations were you had to live there in order to use this loan and buy this 4-unit building with better interest rate terms and such. So sure, it wasn't easy to live in a tiny little house, but we were more interested in reinvesting into my real estate business and using this little thing as a tailwind and a million little things like that. We only had one car for a long time. We don't go on fancy vacations. It just, you get in it, and it's not even really like it doesn't take much discipline or exercise of will to do that. It's just the habits we've made. We haven't made a habit of excessive consumption, enjoying fancy things, and we just don't really care about that. And so that's really, the answer to how do I keep my overhead low and why. Does it make sense to you?
But I've noticed it's across multiple risk takers.
Mm-hmm.
Actually, every single risk taker, if you even look at our friends, they're not very flashy people. And it was a lot for me to buy a nice car recently. I had to go through a breakup to get myself to buy a nice car.
Life, like midlife crisis or whatever, your quarter life crisis.
Yeah. So I don't know if it's actually unique just to you.
No, yeah. I was speaking from personal experience, but this kind of gets into the second part of your question when you're asking me more broadly, why do risk takers have these qualities? And it's easier to answer pertaining to myself because I know the way I think and everything. But, to speculate on why these things tend to show up in different risk-taking personalities, I don't fully know the answer, but a lot of the time I think part of it might be successfully taking risk means you need to have a somewhat clear view of reality. So it's like, you can't, like if you're trying to price the fair value for an asset, whatever emotions, people, or opinions they have about this asset don't matter. Whatever narratives are going on don't matter. Whether you're feeling scared or, it's unpopular to invest in doesn't matter. You kind of need to tune that out in order to get the fair price. And you need good prices to be a successful trader over time. So, the very act of crafting good prices means that you naturally have to be good at screening out this noise. And, perhaps that's part of the reason, risk takers, they screen out this noise of, I need to have this materialistic thing to be happy. They could realize that that's an idea, but it's probably not true. These things, material doesn't bring us happiness, true happiness and joy. And maybe they can realize that, I don't know, more innately than some other people can. Again, humility ties into it too, because if you're trying to, if you're motivated from pride, or fear, I want to make a ton of money so I could be cool. Whether or not what your personal desires are, don't impact prices at all. So it's like you got to let go of those to be focused on price and trade it accurately. So maybe that's where a degree of humility comes from. It's like you have to dismiss a lot of these things that aren't actually real. You need to just be able to strip that away, focus on math and reality, and what's the actual price, what's the actual risk, and maybe that kind of is easier for some people than others because of their personality. We might have aspiring risk takers that aren't humble and they're prideful, but those qualities might screen them out from being successful in this industry. And so, we don't hear about them. The survivors, like the risk takers who have been around for a long time, maybe it selects positively for qualities somewhat similar to humility or whatever you're recognizing. Just, again, that's a theory, but
that makes a lot of sense to me though. If the asset's worth $10 and it's trading at $8, before you hit the buy, you can't be thinking about, can I pay for my Lamborghini? Can I pay for
or even I'm scared. I don't want to lose money. Like I my ego doesn't want to be a loser. Right. I just lost on a big trade. I need this to go up. If you're in a losing trade and let's say we thought it was worth 10, we bought at 8. New info came out. It's really worth 5. We're marked down. If there's no edge, get out of the trade. But fear of losing or kind of a prideful ambition to avoid pain or get glory might cloud your view of just make the mathematically sound decision. Once new information comes out, it reprices your asset down. You just take the loss. I mean, some people can do that easier than others.
would you say risk taking? You're a born risk taker, or it's risk taking can be taught?
I think some of it, we're pretty malleable as, humans can learn a lot of different skills, and it's not normal for us to completely change our personality, but, I've been surprised the amount of personal growth and skills I've seen myself and other people pick up. So yeah, I wouldn't go so far as like kind of the nature versus nurture. I wouldn't go so far as to say you could teach anyone how to take risk just as good as anyone else. There is some natural talent, and if you have a more analytical mind versus a more artistic mind, maybe that would be better suited to taking certain types of risk. The qualities of like humility versus an inclination to pride or greed might make it harder to take risk. I really think it's a hard question to answer. There's a mixture of both. You can learn how to take risk better, but some people are more comfortable with risk and some people aren't. And I think that probably is fundamentally not going to change. I know people your personality traits aren't fully within your control. You're created with a personality, and you can develop it and grow it, but you're still you. You're not going to I'm not going to wake up tomorrow morning and Jordan's like, I decided to be a completely different person, and he's like a stranger to me. You can't get away from yourself. You're going to have these qualities that make it easier for you to take risk, and someone else might not have those qualities. And we also got to be thinking, what is it best? I have a certain set of talents and gifts and interests. You need to ask, what would it be best for me to be doing with these things? Even if you wanted to take risk, but you've just like, I got to be honest, I'm just not good at it. I'm not comfortable with it. I've got a little bit of risk on, and I'm just sweating bullets every day. I can't sleep. It's probably not right for you to try to overpower those things in order to be a risk taker. So yeah, you could learn the basics of risk taking, but I think everyone has different strengths and weaknesses, and we shouldn't try to ignore that. So I don't know. So you get into these abstract questions, and I feel like I don't have clear answers for you. It's just
it's making perfect sense.
Yeah, a lot of random thoughts come out.
But on that note, Steve, about like not being able to, when you, and I see this with you as well, when we are in huge risk positions, like it's mentally taxing.
Oh yeah.
And even for me, having lost 1.5 million in a week on arm, my body like shut down.
Yeah.
When I had the position on. Once the position was off, even though I had lost that money, I was like,
The interim is way more difficult than the aftermath. Yeah.
I remember I had lost 1.5 million, and then I was like dancing in my condo, had the music going because like the position was off.
Yeah.
Like just get that off my books.
Just knowing is like, way better. Even if it's accepting a loss, it's the unknowing, there's a psychological component where even if you intellectually think this risk is good to take, I don't mind carrying it, and with my higher reasoning faculties, there's still, this psychological weight in our nature that is definitely harder to, it's not fully within our control. It takes a lot of personal growth to get to the point where we don't just know money's numbers on a screen and we ought to be detached from it. We don't just know that in our mind, but we have integrity. That's our entire being just literally doesn't care about it anymore. And we've finally broken our attachment to money, and then it wouldn't bother you at all. I mean, if you truly had this idea integrated into you, like money doesn't matter, I could take, you could have I could say, Jordan, tomorrow you might lose $1 million, and you'd be like, I don't care. If you truly didn't care about money.
Right.
But that you kind of, these difficulties we go through in life really makes you confront yourself, because the thought of losing money, if that is really hard for you, then you might need to be honest with yourself and say like, yeah, I mean, I do really care about money. I'm really attached to having a lot of money. I got to be honest. It will pain me if I lose this. And we all have attachments to different things, and it's a lifelong battle to kind of purify ourselves of those things. So.
Love that. And you've always mentioned to me, like, it's our job to take risk. And if you can't hold the risk, this business is not for you.
Yeah. Don't try to force yourself. If you're uncomfortable with risk, again, your personal well-being, like I said earlier, like same kind of in a similar vein as to how are my time and talents best spent in the world? How do I do what God created me to do? You should also ask yourself, like, what's best for me to do? Is it best for my mental well-being, my family? These are all things that are way more important than numbers flashing up and down.
Yeah.
So don't trade higher for lower. Like, don't sacrifice your mental well-being. Don't destabilize your family. Take too much stress. Don't give away your health just for some money. I mean, you're putting something of a much lower order above more important things in that case, and that's disordered living. So we always need to resist this pull to disordered living. It's not always easy, though.
So one thing I love about you, Steve, is like how down to earth, how humble, how like connected you are. Even I find that with trading, it's easy to get disconnected from our humanity.
Mm-hmm.
You know, you're just behind a screen, numbers are flashing up and down, and it kind of takes away like the humanization.
Yeah.
I don't know if that's a word, but with you, I feel like you're really in tune with your spirituality, who you are, what's important in life, your values. And I think that also makes you a great trader as well. It's not just you are detached from money. You realize that like if everything went to shit, you'd still have your family, you'd still have your health.
Yeah.
And so let's lever up.
Mm-hmm. Yeah, and I hope even if I lost those things, I'd still be at peace.
Wow. Okay. I would hope so too. I know you went through a big loss recently.
Yeah. My in the wake of I lost my grandfather 2 years ago, and that was really hard. The first time I lost someone really close to me, and then I lost my brother this last October, and that was he was even closer to me. So yeah, and in the span of this risk-taking period we're talking about, past 5 years, 2 major losses and one very recent. My brother we were so close growing up. He was my best friend throughout my whole childhood. Felt like it was me and him against the world. I miss him a lot. Think about him all the time still. That has been hard.
Yeah, and actually to be down in Chicago with you and to see, you know, to be around you and be around your presence and see you just like be the rock for your whole family. And it was an incredible sight to see, Steve.
Yeah, it was incredible that you were able to. He came down and stayed the whole week with me while I was planning the funeral and doing all this stuff. And
of course.
It was so great to have my best friend there. Yeah.
Okay, Stevie, you know what? I want to get into some stories here.
Okay.
I know you have some unbelievable stories, some stories that we've shared together too. And do you have any stories you want to any trading stories?
Yeah. In the prompt we were kind of going over. You asked me think best and worst trading story, cool trading stories. Well, the one that instantly came to mind was 2 years in a row actually. We traded the same thing, and I think the first year we traded. This was a natural gas trade, so it was 2021. That might have been after the Russia-Ukraine tensions started, or maybe right before. But regardless, it might have been before the actual fighting. But sanctions were put on Russian gas, and that just really put a huge bid into the market. A ton of supply got cut off, so natural gas in particular was really backwardated. Like the front months, like November, December, January, it's wintertime where it's cold and people need gas. Huge amount of supply gets cut off. And so the spot price and the vol was just blown way out of proportion. There's a huge risk bid on this. And me and you both were like, oh, we got to sell this. We got to sell this volatility. We got to sell this. And so we really sized up big there. I was like, I know this bid is not coming from fair pricing, but it's just a supply shock. It's a huge risk bid. You know, a lot of the times markets, when unexpected things happen, people positioned in a certain way will get forced liquidated. So now they're not buying because they think this is the fair price. They're buying because they need a layoff risk or they're being liquidated. And so yeah, we both looked at that and we're like, this is a dislocated market. We need to sell this risk bid. And that whole winter was just, we opened up with a massive position in short vol and natural gas, and we wanted to hold short deltas too. We wanted to be just short the risk event. But it was a scramble to find every place we could to offload this risk. We were buying February, March oil to try to offset the short January we had. We were trying to look for correlated instruments and buy vol in other places.
Yes.
And
Steve,
that was a.
I think this is a great story, the natural gas trade
Mm-hmm.
that we did together, and I wouldn't mind breaking that one down step by step.
Okay,
I mean, it's a moment in my life that I'll never forget. Steve and I are actually getting a painting done. We commissioned a painter to paint the story of this natural gas trade. So You know what, Steve? I'll kick it off with
break it down for us.
I'll kick it off with how it started, and then from your perspective, maybe we can actually both chime in on this trade.
Yeah, let's hear it.
So I remember I was just coming back from Las Vegas, and I had a friend also named Steve. He was staying with me at the time, and I usually wake up late, so I wake up just before market open. Actually, sometimes a little bit after market open, but
only if you don't have a big position on it. I hope.
Exactly. So I was coming from Vegas. I was a little tired, a little hungover, and I get this like knocking on my door at like 9:30 in the morning, like pounding. And it's my friend Steve, and he's like, natural gas in Canada, the natural gas ETN in Canada is trading different than the natural gas ETN in the States. So the vols were
it was a
dislocated.
liquid. So, the risk bid flows to like the deepest liquid market. So yeah, US, the D1 got hit and vol got hit even harder. So it's like, yeah, when there's concentrated risk, you often see a breaking of normal correlations. And yeah.
Yeah. And I was like, what do you mean? And he said, HNU, which was the natural gas ETN in Canada, same product as Boyle in the States, totally dislocated. And HNU was trading at 100 vol. Boyle was trading at like 210. And one thing I love about our business is when there's edge, like it's go time. So I like barely put on clothes, sprinted down the street to the office, and got behind the screens. And once I saw that, the huge dislocation, I instantly sent you that message.
Yeah.
And the way it works is in Canada, we don't have portfolio margin, so we can't, it's not very margin efficient. And that's actually where Steve and I, where we first connected, was Steve was this person who was able to take the short side of trades.
Yeah, I'd be the hedge for some of his trades or vice versa. Yeah, we'd have like a spread on, but it wouldn't all be within one account. It would be split between us. We'd have a global position that we'd both work together to manage. Yeah.
Yeah. And so from there, we started getting size. And I remember just the depth. There was this one guy coming in at the market close every single day. And it was just the more I could click, the more money we would make.
Yeah.
And, after day one, I realized I couldn't click fast enough. So I went and bought like one of those gaming mice, like those gaming mouses. So I could like triple click in one press.
Yeah.
And we started getting pretty big size.
Yeah. Jordan was like, oh, we're going to be able to hold all this or whatever. I'm like, because again, we talked about which leg is mispriced. Well, if we find a mispriced leg, I was like, just get as much on as you can. We'll figure the rest out later. Like, that was my mindset.
Yeah.
I'm like, just
Yeah.
Add as much as you can. And so
then I said to myself, I remember there was not a lot of sleep during this period because we needed to, whoever this guy was that was coming into the market, just placing offers, we needed to take him down for as much as we could. And so I remember staying up one night, just like coding in Interactive Brokers, a robot that said, because he was like quoting odd lots, like 11 contracts. And I was just like, I had to code this fast. And I said, if you see an order with an 11 lot offer, buy it. I don't care about the price.
Sight unseen. Yeah.
Yeah. I don't care about the price. Buy it. And the next day, I think we got like 10K Vega or something.
Yeah, it was huge. We accumulated a ton. Yeah.
It was huge. I just, right at the close, he came in, I pressed the button and I just took him for all his size. And so we're talking 100 vol on my side, 200 vol on your side. So 100 vol spread. What do we have? We must have had 5K Vega, 6K Vega.
Yeah, again, like we talked about so many times, it's like once the trade's done, like I can remember the concepts, but the numbers, details, I don't know how much Vega we had. I don't know how much money we made. I just remember the story, like the broad strokes, yeah.
And then we realized, I'm going to let you take it away from here, Steve. We realized that we had too much size on.
Yeah. I was like, add the edge, and then we'll worry about the rest later, but we could only get rid of our loss case if it was a perfect spread against, one asset, like the same asset. You need to replicate the same asset or as close to the same thing as possible. and you're long something at 10 and short it simultaneously at 12 in a 1-to-1 ratio, that's the perfect ARB. So it's like we couldn't construct the perfect ARB. We tried to get as close as we could to it, but even then we didn't have like on my side to fully spread off what Jordan had, and even on his side we didn't have enough capital to create the ARB. So we were like, oh my gosh, we have like one-sided risk on this trade. What do we do with it? It could turn out really well, but it could turn out really badly. So we added a lot of edge, but we had a lot of variance too. That whole winter was just like a scramble to reduce variance. So it's like I shorted as much as I could on my end. We went into other months of the calendar to try to unload some of the risk. I would be like short at the money vol, but then I'd buy like wings. Like I'd overpay for them, but at least it like would reduce our spike risk like way up and out. So I was long like call wings, and I remember this one particular weekend, futures opened at like 5 p.m. or 6 p.m. on Sunday. So always like right when it opened, I checked natural gas, and there was one time it opened and it was like open 5% above what it was on Friday, which is like huge move. Like 5% means 10% standard deviation, and we're talking like that's 1,600 annualized vol. So it's like way more than what we shorted, which means that all of our short leg is going to be down huge. And I was just watching this, and fortunately and unfortunately, the brokerages are closed. Only the futures are trading. But I just know when we open on Monday, I'm going to be down like 200,000, 250,000. It keeps going up too. It opened 5% up, but I'm watching it all Sunday evening. It's like 6, 7, 8, 9, 10, 11% above Friday. And so I open up Monday morning, and already our short leg is getting liquidated, which that's going to even give us more variance. We already had some variance because we were overweight long, but if our short leg gets liquidated and then we're stuck in this long leg only, that's going to be even more risk. And again, if natural gas keeps, risk can cut both ways, so that'll make us either earn a lot of money or lose a lot of money. But we didn't want to bet our whole lives on this one single trade. We wanted the spread on.
Yes, we did.
And so, yeah, we were scrambling. I opened up, barely avoided getting liquidated for one day. I actually had to lend money from 2 family members, like scrambled, so I could post more margin and hold on to my position. And luckily, I have such a good relationship with my family members, and they were able to understand what was going on. And they trusted me. I'm like, this isn't just some harebrained scheme for you to like take out money on your home equity line and it's going to be gone tomorrow. I'm like, no, we have a position that's like offset right now, but I don't have enough buying power to hold it. Yes, there are some risks, but again, they entrusted me with that like really quick capital. So again, by hook or by crook, that was the worst day, but several times we had like weird bulges in certain pricing that would get close to forcing us out of the trade. It's hard to remember the exact details, but even when we were talking about it, sometimes minute details, we'll remember them differently. But in my mind too, I think there was one point in time where we wanted to be neutral on the price of gas, but just because we had so much risk in the volatility, I think we had to inventory a long position for a while, long gas, after it already blew up. So we kind of knew these were toxic deltas, like probably natural gas is going to come down after this. You don't want to be long if the floor is going to drop out. But in order to hold on to the vol spread we had, we needed to carry a long position in natural gas. But luckily, we lost less on that than we made on the vol spread. But again, it was an extremely messy trade. Like just got through it by the hair of our teeth, or whatever the saying goes, several different times. But it makes me smile just thinking about it. It was an adventure.
Yeah, I remember I was at the cottage actually, and I was like, you were telling me, hey, I think we're gonna run out of liquidity here.
Yeah.
And I was like, no way. No way. Like, there is no way this is going down. And we scrambled, but we ended up pulling through.
Yeah, yeah.
We actually had a friend the second time come in and provide liquidity for us.
Yeah, that was great too.
But, I love those moments when you're like fully packed on, and I think that's what we live for sometimes. That feeling of...
Those are the problems that you get paid to solve as a risk taker. I mean, if there's no problem to solve and everything's calm and everything's fair priced, we're not just betting like that numbers randomly go up and down or whatever. Risk premium, like we talked about early on, risk premium exists because there's certain scenarios that are difficult to get through, like the supply shock, the sanctions, all that. It's difficult for like oil producers to react to. They want to buy insurance, but no one wants to sell it. The market, this is where risk takers can step in and actually provide value and utility to the rest of the market. Like that's one of the things that I think not to be too defensive of risk takers and traders and like justify our existence, but sometimes risk takers can get a bad reputation. Like, well, they're just gambling, or they're somehow extracting value from other people and making themselves money at the cost of other people's. But I think it's impossible or very hard for most people who aren't involved with markets to understand just how much value liquid free markets add to our national economy or our international economy. Illiquid markets really diminish the efficiency that everybody can conduct like productive activities with, and quality of life goes down and everything if you don't have liquid and free markets. I mean, imagine you get a new job, you want to sell your house in city A and go to city B, and then you're like an expert in manufacturing, and this growing company wants to supply manufacturing tools for the other local businesses, and they want to hire you and everything. But what if the housing market was completely illiquid and there's no one who's either legally allowed to buy or sell property, or it's so restrictive that you can't get honest people coming in and managing housing inventory, buying and selling it? You're going to be stuck with a house that you either can't move and can't go do this job that's going to provide real value, or you're going to have to move to the city anyway, and that company's going to have to overpay you because you're going to have to pay for an empty house because you can't sell it in this city. Or mortgages. Like, what if the bank gave you a mortgage, but there weren't investors behind it to buy and sell? Banks might say, "Oh, we got more risk, so or interest rates went up. We're just going to double your mortgage payment because we want to cover ourselves." And there's no, like, if the market was completely illiquid, you're going to get price shocks. You're going to get inefficiency. Like, it's hard to conceptualize for a non-risk taker, but free markets add a lot of value to society and a lot of quality of living. I mean, you can even study like the middle class, like how it's grown over the centuries, and the basic necessities that everybody has. And on the heels of many major financial developments, like the creation of futures systems where people can trade commodities at different prices. Now you're an oil producer. You can lock in a price of 40 per barrel, and your employees are going to be paid and employed for the rest of the year. When in the past, before futures, if your cost of production is $20 a barrel, oil is 40 right now, but you can't lock in that price. Next week, the price goes down. Then what? You shut down your factory, or you go bankrupt, and all your equipment and capital machinery and everything just gets, sold off or put out of use. Again, it's theoretical stuff. It's hard to explain, but I was like, risk takers meet real needs in the world, inventorying and managing risks. People buy insurance all the time. What if you couldn't buy any insurance?
Right.
So your house burns down, and you spent $200,000 on that house. You still have a $150,000 mortgage that doesn't get forgiven because your house burns down. What if there are no insurance companies? Now bad luck just wipes you out, and now you can't send your kids to college, whatever. Like, you can't even buy a new house because you still got a $150,000 loan. You're going to go bankrupt. Now every single homeowner needs to have $200K in their pocket in case their house burns down. Like, no, insurance companies let you offload that risk to someone who's qualified and capitalized enough to manage it for you. And it's important to have competitive markets too, because if you're the only insurance guy in the world, now you're like, I know you need me. I can charge you whatever I want. But if we have free markets and there's 10 different insurance companies, you're inefficient. I'm just not going to use you. I'm going to use this guy that quoted me less. So it's like people don't really realize like just how much productive efficiency hinges on having fair and free markets and, the ability to take risk present. So
Steve,
there's my little soapbox.
Steve, I'm actually so happy you said that, because I think as traders, we go through that period of like, am I a good person? You make all this money and you're not really seeing any value.
Yeah, it's different than making
creating
a tangible product. Like, a carpenter makes a chair, they could look at the chair, they could sit in it.
Right. And then you see someone sitting
we work
in the chair,
in more abstraction than that. Yeah.
Exactly. One thing you did tell me though, and I've been really taking this to heart, is what you do with the money.
Yeah.
So as traders, if you're going through that phase of like, I'm making money, but I don't know if I'm a good person. I think a lot of us do go through that. What you can do is actually you can start doing things for other people and giving gifts, helping out, donating.
Yeah.
Those are all different. Those are all ways that you can, help people. like tangibly,
Yeah.
and see
Yeah.
you actually making a difference in the world. So, but you know what though, I do love how you said that, Steve, because there is definitely a role for risk takers and holding risk. Steve, we're coming up to the end of the podcast here, but I do want to touch on one more thing.
Sure.
Before we close out here, and is what we mentioned last night, because I do want other traders who are listening to this podcast, I would like their opinion on it as well, which is what we talked about with this merger arbitrage idea. The idea that, actually, I'm gonna let you explain it, but maybe you can talk a little bit about your current position on Save, and why you think that merger arbitrage does provide that risk premium, because it was very theoretical, but it also made a lot of sense to me, and I was thinking about it all last night.
Okay. Yeah. That conversation. I think we got on the topic because we're saying some things in the market, just because something has the possibility of an outside loss. So just because something has risk, like for example, writing insurance for any type of risk event that it could be outsized or whatever. Just because something has risk doesn't mean that it will have risk premium. So it's like, what if, again, we're talking about house insurance. It cost $1 million I have to pay out every single year for when someone's random house burns down. And let's say I collect $1 million a year in insurance premiums. That means my insurance premiums I'm charging are priced to exactly a profit of zero. They're priced in an exactly risk neutral manner. There's no profit margin for me. Now, probably I'm going to go out of business because I need to go. It's better for me to go get a job and work for somebody else and actually make a profit margin or enough to. If I'm just netting zero, I'm not going to be able to fund my life, pay my mortgage, whatever. So anyway, just because I was taking risk doesn't automatically mean I'm going to get paid for it. There's a risk that isn't paid money. Like for example, if you short the S&P, it goes up 10% every year. You're going to lose money. That's risk to you. If you're short, S&P going up equals risk to you. You're not going to make money long term doing that because the market usually goes up. So a lot of risk activities don't have risk premium attached to them. And we're kind of talking about why are some risks compensated and some aren't. And it kind of gets back to our earlier discussion a little bit. I think because some value needs to be provided. Shorting the S&P, the market's not paying anyone to do that. That's S&P upside risk is not a problem for the whole world that we're paying risk takers to go solve. So you really got to start thinking to yourself, does what I'm doing have a risk premium and why? I like to have a theoretical justification behind these things. So anyway, we're talking some things, even though they have risk, don't have risk premium. And sometimes things could have a lot of risk and they still don't seem to have risk premium. And then you might scratch your head. You're like, why are these things fair priced? Like certain vol, or commodity spreads. Why are they fair priced if they could? Who even trades them if they don't make money trading them, but they could still lose?
Like selling vol around earnings is what we talked about.
Yeah, that's a perfect example or whatever. Earnings volatility seems to be fair priced. If you sell it, though, there's a lot of risk to that. Sometimes you lose a lot of money, but just because there's risk doesn't mean you earn money doing it. And we were talking about merger arbitrage, which is basically if a company is going to get bought out, there's a time between when the agreement is made and between when the transaction actually occurs, where the shares are still trading on the public market. And let's say I was going to buy out Jordan's podcast for like $100 a share, and right now his podcast is trading for $80 a share.
Way more.
All right, I'll multiply those numbers by whatever multiplier you need to. But so the offer goes public, and what should the shares of your podcast trade at? If I'm going to buy them in 6 months for $100 a share, well, they shouldn't go right to 100 because what if I change my mind? What if a judge blocks me from doing this? Whatever. They're going to trade at something less than 100. And there's the risk neutral pricing, which would be someone tries their best to paint the whole distribution of, I think Steve's got a 90% chance of doing the transaction, a 5% chance of changing his mind, and a 5% chance of at the last minute, the government says, Jordan, your podcast is illegal. We're shutting it down, and then I can't buy it. So you have a distribution of outcomes, and you can craft the theoretical risk neutral price But what we find is with merger arbitrage, a lot of the times things trade under the theoretical risk neutral price. And so we were just kind of spitballing, why does this particular risk seem to have risk premium? Why does it seem to trade under the risk neutral probability? And I think one of the thoughts I had that interested you when we were just kind of theory crafting was some markets are double-sided where, like, for example, everyone who buys an option, it has to have a seller. Like, there needs to be a counterparty that pays out on your option in order for it to exist. So the buyer is going to be like pricing as much risk as he can, and the seller is also on the other side pricing as much risk into it as he thinks there is. And you either meet on a price and execute your transaction, or there's no trade. And if you have a double-sided market, you're going to be pretty close to risk neutral pricing. But if it's only a one-sided market, let's say you thought the fair price for this option or this asset was $10, but like we were talking about earlier, how much risk should I take? What if Jordan, the price is $7 and he buys as much as he can, and now the price is $8, and he's either out of money or he's sick of taking risk or whatever. He just leaves off, and this thing kind of floats under fair value because there's no other buyers that want to take that risk. And there's no liquidity on the short side per se. Like, there's not a short position for every long equity position. There's no one on the short side kind of pricing that stock up to cover their own risk. Because if you're short from 8, now you're going to be like, well, I think it's going to be worth 10. You're like, no, I'm going to pull the price up to like 9 or 9.50 because that's acceptable risk for me. So in markets that have a lot of one-sided flow or that don't have a perfect 1-to-1 ratio of risk capital on both sides, my thought was like maybe it makes more sense for risk premium to exist in places where the markets are more one-sided instead of double-sided, because you only have risk capital going into one side, and it's not quite the same as a buyer leaving off before we hit fair value to someone actively putting their capital at risk at odds worse than fair value. So I mean that's kind of theoretical, but is that what you're talking about? That part of our conversation?
Yeah, that's exactly what I'm talking about.
Okay.
That if you don't have a two-sided market, then there's no need. And when we say two-sided market, two-sided risks. So risk on both sides.
Yeah, risk capital on both sides. Like real people risking their real capital on both sides.
Yeah. If there isn't that, then you can actually find some pretty big risk premiums.
And again, going back to the beginning of the podcast, interest rates themselves is kind of not a fair two-sided market. The government's taken over controlling interest rate policy. Would real risk takers and real investors have been lending money for 2% in 2018? Or, if it was a perfectly fair and free market that wasn't heavily influenced by government monetary policy, you might not have seen those dislocated prices. But they did exist, and I saw them, and I thought they were dislocated. And again, that might have been because there's this obstruction to the natural risk-taking and pricing mechanism that exists. So,
brilliant. Steve, thank you for coming on tonight.
It's a pleasure.
Absolutely pleasure.
Yeah.
Loved having you here, and hopefully I'll have you on again. Hopefully
your podcast takes off. We're hopefully these numbers. I buy it out for 100, it goes to 10,000 a share. Yeah,
hopefully. Well, Steve, thanks again, and I appreciate everything that you've done.
Yeah, likewise, Jordan. Thanks for having me.